Tuvin, I hope you're recording the meeting.
Yes, yes.
Yes, Tuvin and I are both in the code team, so we will share the network.
Do you guys have basic understanding of how banks work?
I think it would be better to start from the beginning.
Yeah, okay, I'll explain.
I think today's topic, credit risk analysis, seems a little difficult for most people,
Yeah,
but I hope it will be easy by the end.
so should I start?
Yes, I think so.
Yeah, so basically, before we go over to the risk management, we have to first understand how do banks make money. So, if you go to any retail bank, what do they do is they take money from you, the depositor, and they lend it out to other businesses or other borrowers. So they charge you. So the banks make money by from the delta between the interest rate that they offer to you and they charge the interest rate that they offer to the borrowers. So, for example, if they're charging, say, if you're going to buy some home, or let's say you're buying some vehicle, so you'd be you'd be asked to pay an interest rate of say 6% something, and then the borrower 6% something, and then the depositors will kept the money in the bank. They will be offered, let's say, 5% of interest. So this differential 1% is what the banks makes as profit. So that's how the bank's business model works at a very basic level. I'd say it's a retail bank. That's how it operates. Now the question is, so when you're lending out to borrowers, you have to accept a certain portion of the loan would never be recovered. Some people would go default, so they would have to register for bankruptcy, and the money will forever be lost. So you have to write that off. But the depositor, you cannot just now there is no option. Either you can say to depositors that you cannot pay back the money that you have defaulted on the promise to depositor, or else all the bank have to write off that amount and pay to depositor. So the money that the depositor will receive once the borrower goes default, either comes from bank's war chest. By war chest we call the bank's already cash reserve, or it will make a promise to the depositor that they will pay at a later date, and they'll set up I'd say, payback plan. So it's usually stretched. So, for example, if if there is a huge quantum of cash reserve that has been lost, so what in that case it will do is it will say that here's the thing, you have this much of money pending with us. We'll pay it over a certain period, let's say 6 to 7 years. So that's the kind of promise they make. Or sometimes a bank goes bust. For example, in 2008 crisis, what happened is the Lehman Brothers went down, and the Lehman Brothers had to be sold to pay back the depositors or whatever that was left. So that is the thing. Now coming to retail banks, there are different kinds of loans. For example, you have credit card loans, you have mortgages, basically the kind of loans that you take in lieu of buying a home. So mortgage is there. There is auto loan is there. you take that loan out for buying a vehicle. So you have overdraft. Overdraft is basically it's like credit card, but it's based on it is based on your current account. So you have say $100 in your current account. So you go to the bank and say I'll take say $50 more on the current account. So the bank pays you $50, and the bank uses the current $100 as a collateral. So in case you go bankrupt, you default on the payment, the bank will just block that $50 from your current account. That's what it is. That's called overdraft. So there are different kinds of loans. So the loans differ by different characteristics rather. So for example, also there is personal loan. The personal loan that banks gives out to you saying that this has this much interest rate. So around a bank personal loans I have, I believe it is 10% interest rate in India. So that is there. So how do these loans differ? So the loans have different characteristics. For example, the personal loan is not backed by any security. It has no collateral. So you can go to any bank and ask for personal loan; they will give it to you. So that's what it is. And you are not backed by any security. Hence, if you go bankrupt or default, the bank actually has no way to get the money from you. So to offset that kind of risks, bank charges a very high interest fee. So that's what happens for personal loan. Now you have overdraft. Overdraft is secure because it is backed by your current account. So depending upon whether how much money do you have in current account, the interest rate is usually fixed as per the level of money that you have in your current account. So that is there. It is somewhat secure. Then you have mortgage. Mortgage is a very secure loan because when you go to take out that loan, you also give out your title deeds. That is the bank. That is sorry, the property documents to the bank. So the bank can effectively take ownership of the property in case you go default. So mortgage is very secure. Vehicle finance, yes, it is secured, but it's also unsecured. Why is it unsecured? Because when you take out a loan, you take out loan for a say car, and you must have to, and you probably know that car is a depreciating asset, so its value decreases over time. So if the loan tenure is too big for the to recover the money, for example, if you buy a sedan for some 10 lakh rupees, and the loan period is set over, let's say, 13 years. So what happens is, and usually a car these days have a like 15 to 20 years of valuation period. By valuation period, I mean after the end of 20 years, the value of the car decreases to zero. So by the 13th year, okay. So by the 13th year, what happens is a significant portion of the value of the car has reduced. So let's say someone defaults at 12 years, at the 12th year, and the person hasn't paid the money for let's say 3 years, last 3 years. So effectively, the bank will lose a huge amount of money because by the 13th year, the car's value is significantly reduced. The bank doesn't have the bank loan installments paid in time, and if the bank now takes ownership of the car and sells the car to someone else, it won't recover that much money. Definitely not amounting to the initial loan that he had actually lent out to the borrower. So car loan is pretty much is secured in terms of that it's backed by asset, but it's also unsecured because you won't get the value paid in. You won't get back the uh, loan amount paid in full. So that is the thing there. You have vehicle finance, mortgage, personal loan, overdraft, and credit cards. Credit cards are also very unsecured loan. So when you go to, so if you default on a credit card, so there's no other way to get the money back. But also the risk quantum is less because credit cards usually are not very much used. Credit cards are usually used by retail customers. So usually credit cards limit varies between say 1 lakh, 2 lakh, sometimes 5 lakhs. That's the most it can vary. So it's not a much. It's not, compared to a bank's balance sheet, it's not a huge amount. So, but then the whole of the bank's risk comes out of say the correlation. What happens is with the 2008 financial crisis, what happened is it's not just that one or two mortgage loans went default. It was like a vast section. In fact, an entire portfolio of mortgage accounts went bust. So when that happened, the bank ran into trouble. So there is one very important assumption that works in foundational banking that not all loans should go default all at once. If that happens, the banks cannot be saved. So, if say for example, even if the credit card defaults are very low, individual credit card defaults are very low amount, and those are not a significant portion of the bank's balance sheet. Still, if a large section of credit card accounts go default, then the bank will be in trouble. So the whole point of risk management is to figure out a way so that you are there are two aspects to risk management. One is not all loans should go default all at once, and two, if it goes, even if all loans go default all at once, it's a macroeconomic event. The bank should have some amount of capital so that it can survive the downturn. So these are the two objectives of the risk management. Do you have any questions up until this point? I could not understand certain things. Okay, I believe you have no questions. That's fine. So this has been I would say that this is how the bank's business model operates and what are the things that they look out for. And so long I have talked about retail banks, now you have the investment banks. So basically these banks basically invest in the stock markets. So stock markets and bond markets. So stock markets and bond markets, as we know, they are very responsive to the fluctuations in the external environment, the business environment specifically. So you have things going on, you have the stock market fluctuation there, you have the bond market fluctuations there, and you have portfolios that are composed of the stocks and bonds. So this, let's say you're owning a mutual fund. I would say not owning a mutual fund, but own a share of a mutual fund. So they have a bunch of stocks and portfolios in their stocks and bonds in their portfolio, which is subjected to very much risks, so very much market fluctuations. So the value of the portfolio might decrease. So if you are a pensioner, so you are living on the dividends that are paid by those stocks. So if the stock returns go very low, so your monthly earning will be in trouble. So as a portfolio manager, your responsibility is to hedge against. By hedge, I would say protect against the market fluctuations such a way that your dividend doesn't take too much of a hit, or the returns do not take a hit. So it all depends on what kind of portfolio it is, who are the customers of that portfolio, what do they want, and what do they don't want. And the risk manager of a say investment bank does basically the thing that it takes care of the thing that the customer wants, and it tries to protect against what the customer doesn't want. So that's what the investment bank managers do. Other than that, you have aside from the retail and investment bank, you have basically what are called the payment processors like the Visa, Mastercard. You have Amex, all these kinds of banks. You have these are basically the payment processor. What do they do is basically they handle the transactions. So handling the transaction carries some amount of risks. For example, if Visa processes some billions of transactions in a second, in a second. So what happens that due to the infrastructural issues, sometimes the transactions might go default, and it could be a bunch of low value transactions getting stopped, or a couple of high value transactions getting stopped. So that imposes a kind of risk there, called transaction risk or operational risks. So that kind of risk can create a loss of trust in the banking system. So when a loss of trust happens, you cannot get that back easily. So banks try to hedge against those kind of risks as well. So you have a bunch of lending risk here, you have a bunch of market risk. Market risk comes in the form of like market fluctuations, and you have the operational risk. In a bank, these are the three major pillar hits of risks. So a bank deploys different teams and resources for managing all these three kinds of risks. Having said that, if you go on to analyze what sort of spending banks are doing for different kinds of risk, you will see the banks are mostly spending huge amount of money on credit risk, the kind of risk that I talked about, the kind of risks the bank hedges against from the default of borrowers and later default of borrowers. So that is called the credit risk. And the banks spend huge amount of money on credit risk, and the banks also spend huge amount of money on market risk. Market risk basically the risk that is born out of the market fluctuations. You have the variation in money, variation of stock prices, you have variation in bond prices. So banks deploy huge amount of resource for hedging that kind of risk. Usually banks spend less in operational risk, but then again it varies from bank to bank. So for example, the British banks tend to spend a lot on operational risk because for some reason I don't know, the British banks are more exposed to the operational losses. So like I forgot the figures, but somewhere around $31 billion per year they spend on $30 billion they actually lose out on operational risks, this kind of transaction risk each year. Compared to that, American banks spend much less on operational risks. So that is there. Uh, these three risks are there. Now, if I go back to the credit risk, so the question is, how do you measure this kind of risk? So how do you know how many accounts are going to default or are likely to go to default? So for that, you use some statistical models. You take out the previous account history. Say, for example, a bunch of people have lent out to you. So by the way, before I go to retail risk management, I just have to mention two things. In retail bank, there are two segments. One are the two they lend out to the retail customers and they lend out to wholesale customers. So basically, the difference between retail and wholesale is in retail loans you give out small quantum loans to a huge set of people. So for example, you and I go to take out a loan. So you basically ask for a very small quantum of loan, and there are a large number of people like us who take out loans. So these are the retail credit loans, and there you have the wholesale credit loans where some businesses want to take out some huge quantum of loans, and these businesses are usually smaller in number. So you could intuitively understand that in a retail credit risk loan, the risk for an individual account going default is comparatively high compared to the a wholesale customer going default. Because when you are lending out money to a wholesale customer, so you're rolling out a huge quantum of money, and for that you do a much more due diligence. Yeah, I'm coming back to. I saw that message. Let me just read that up. Civil score plays an important role. Plays an important role in loan sanctions. How do cannot determine whether they should sanction a loan to the individual is taking loan or the person the bank has no data about that individual's score. Yes, that's actually is done by the bank. It's called acquisition modeling, but I'm coming to that question. So what was I saying that when you lend out money to a wholesale customer, so the quantum of loan is pretty high. So for example, Adani, couple of days back, Adani took some loans out of some tens of thousands of loans. So that's a huge amount. So when a wholesale customer goes to take out a loan from the SBI, so SBI will do a huge amount of due diligence checks on the customer. Uh, and the SBI can afford to do so because these wholesale customers won't be very big in number. There will be very few. So very few businesses will take out that kind of loan. But in retail loans, the banks cannot do that much of due diligence checks because it simply doesn't have the operational capacity to do that. So you have tens of thousands of people taking out loans. So they don't have the machinery to deploy that much of due diligence checks. So the risk in a wholesale customer risk of also there is one more thing. The wholesale customers usually have lots of collateral businesses. For example, they already might have networks. For example, Adani has a network of some billions of dollars. So they can trade it against. They have assets. They have assets. They have other collaterals. They have their own individual holdings. So for example, Adani might have some private equity holdings there. So he might back that. He might use that private equity holdings as a collateral for the loan that he's taking out. So all these kinds of arrangements are there, which makes the wholesale lending a bit less riskier. Individual wholesale lending a bit less riskier than the retail lending. But from a portfolio point of view, you have a bunch of customers that you are lending it out in retail loans. So all of those customers going out bank turning default is very less compared to the wholesale portfolio because you have only a few customers, only a few businesses who are taking out the loans. So from the portfolio point of view, the retail credit loans are much less riskier than that of the wholesale loans. So that is there. Now I'll be coming back to that question. So yeah, if you know about the civil score, I'll just give a brief background on the civil score. What is civil score? So basically, when you want to take a loan, the banks give you a score. So what the score reflects is the score reflects how much likely you are going to pay if you are given a loan. So how do they calculate that? So if you already have a loan history, they basically say your prepayment history, the number of times you have defaulted, uh, how frequently do you pay back the loan, how much loan do you take in, what is your loan volume, I mean the loan to value ratio. So which is basically how much loan have you taken compared to the collateral or your cash reserves. So that's what they calculate. So with all these parameters, they figure out calculate a score, which actually indicates your likeliness to pay back. So that is how the CIBIL score is. Now, when there is no CIBIL score, if a customer is coming to the bank for the first time and have no CIBIL score, what do they do? So at that point, they do two kinds of things. One is acquisition modeling and behavioral modeling. So in the acquisition model, what do they do is they use what all bank accounts that the customer has had in other banks. So they take out that money. So they take out that information to determine whether this person will be lent out that the amount of loan that this customer is asking for. So this is what one thing they do. The other thing that they do is um, so basically they have a bunch of data. So the bank had been in lending business for long years. So they have treasure troves of data relating to the customers' demographics, customers' income history, like other customers' income history. They have the other information like they use customers' addresses as well. For example, if a person lives in a very posh area, they can use that as a proxy to determine how the customer's network is going to be. So if you're the first time customer coming to the bank and you have no prior credit history, they would either ask for your bank account details, so which they can understand what sort of transaction goes on through your bank account, or they will use your demographic data or your demographic information, your personal information to some extent, but there is a check on the personal information. You cannot use all personal information. There are some regulations out there which prevents you from using, say, let's say, gender data or the racial data to be used in their credit risk models to predict whether you are going to get a default or not. So these are the kind of variables that they use. Also, they use what is called the behavioral modeling. So they initially give out your loans. They initially give you loans, and they track what is your behavior of the loan, how much you are paying back, at what frequency you are paying back, and what is your pay down value. So they track these variables, and they also have this kind of data for other customers as well. They match against those, and they figure out um, how much risky you are to the bank. So I hope I answered your question, Aritra. So how FRM can help person career in major investment banks? See, if you're a fresher, FRM can help you. But if you're not a fresher and you already work in bank, then it is of no use. So by the career opportunity, I would say I hope you know there are I list a few firms. So for example, you have HSBC is there where I work, and then you have UBS, you have RBS, Credit Suisse, Amex, Capital One. Uh, you have Capital One, you have Fidelity, you have Swiss RE, Northern Trust, you have the other four bunch bracket banks are Goldman Sachs, Morgan Stanley, JP Morgan, all of these banks. You have these banks as well. So I would say there are like the tiers in the banking industry. So you know the bulge brackets are the topmost ones. So below that you have Credit Suisse, you have UBS, Royal Bank, you have Northern Trust, you have Standard Chartered. These are the banks that you have. These are like the tier 2 banks because the pay is slightly lesser than the tier 1 banks and are somewhat easier to get into. And then you have the tier 3 banks. So if you're targeting the investment banks, the best option should be to, I'd say, not go for FRM because there are two things here. Because FRM is very niche area. Okay, it's just deals with risk management, and the chances are high that um, you might not get into the risk management area. So what happens is for example, in Goldman Sachs, they don't entertain people other than from ISI or IITs. So that's what I've observed because I myself went out to apply for Goldman Sachs in their counterparty credit risk department. So they basically rejected my applications, saying that they don't take in anyone from ISI or IITs at the entry level. So what you can do is instead of FRM, you might want to pursue CFA and then top it up with some solid econometric courses or econometric courses or say statistics courses. So I think that will be better than FRM. But yes, if you can pursue FRM, that is good. It's good for getting into entry positions in banks. So if you're a fresher, that will be of help to you. But if it was up to me, I'd rather go for CFA than FRM because CFA is much more broader in scope and and it opens up a number of roles for me, just not just not in risk management, also in other domains as well. For example, there is this area called I don't know if you know controls. So the controls is a part of risk management, but it is not it's not a core risk management role. Basically, what they do is whenever you put a risk model in the any kind of risk model, there are set of model parameters. So control stream basically matches the model parameters against what the previous submissions have been. So for example, there has been previous model submissions, and there are model parameters for those models. So they compare the model parameters of the previous models with the recent model that we're deploying. So that is what the control team does. So it's not a risk management role, but I have seen most people from the control stream, mostly the people from control team have CFA in their resume. So so it could be a spurious correlation, but that's what I've seen. So that makes me infer probably the CFA is more a go-to option than FRM. That I'd say. Also, but I have seen people pursuing FRM. So these people are mostly, I'd say, very much into the the risk modeling area. They're into the I don't know if you know about this. It's called risk strategy. So basically, you have a risk management model. So the risk management model goes into production. So the model performs. So you have the model results. So as per the model results, you get some data, and the risk strategy team basically decides whom to now. How do I change the capital deployment characteristics? So for example, if I come to see that certain segment of the population is going to default more often than others, so I basically restrict the loan flow there and deploy to the other segments where you see people are taking out loans and paying it back. So that's the risk strategy. So risk strategy people have seen those are FRM as well. So that is there. And if you're targeting the major investment banks, so for example, if you're targeting Morgan Stanley, JPMC, um, the most important thing that I've seen is most of the fresher in the entry level, most of them are statisticians. Mostly statisticians or they have analytics backgrounds. Either they're from ISI or they were actually initially targeting from some quant roles, but they could not land the quant roles and made it to risk management. So these are the kinds of people I've seen. So I'd say before even if you consider IFRM, make sure your statistics background is very strong. So by the statistics background, I'll give you a few idea what sort of statistical method that you have to use. You have to use time series. You have to use, let's say, linear regression models. You have to use generalized linear models. You have to know survival analysis. So these are the kind of statistical method that you have to know. Also, there are a bunch of other statistical tests like the hypothesis test, t-test, and chi-square tests, and all of these tests that you have to know. So if you are, I don't in the engineering, I believe you just only taught linear regression and all of this. But if you can beef up, there is this book called of Nimes Dickion Petrus models or the risk management. So you can read up those or take up any econometrics textbook and become thorough with it. And then I think that will be sufficient background to get into major investment banks. Do you have any other questions? Yeah. So I'd say from career point of view, because see, you can read all of these things, but this don't make any sense if you don't land up any job. So I'd suggest for career perspective, make a list of banks. So for example, as I said, there are multiple tiers within the banking industry. So you make a tier. For example, I know for certain that JPMC has a criteria of taking only people who are well versed in statistics at the entry level. If you want to check their website, their career portal, you see is very specifically mentioned these are the statistical methods that we use, and these are the positions that we are hiring for, and these are the statistical methods that we use. Yeah. Is it necessary for statistical background specific to the risk management only? Yes. Yes. I'd say at the entry level, yes, because most of the jobs at the entry level are mostly for analyst job. So this what this analyst do. So for example, I'll tell you what my day-to-day job looks like. So I work in the MENAT region of the HSBC. So Middle East, North Africa, Turkey region. So for example, I'm given a data for, let's say I'm working currently on the Arab data. So they give me all the customer specific information and all the account level information, all the loan volume information to me. So I do the data reconciliation check. I check whether those data sets are correct or not. So basically, we have multiple data sources from where the data is coming in. We check against the data values for those multiple regions. We see if there is any discrepancy. For that, we use bunch of graphs and charts, and also we see if two time series are statistically different from each other. By statistically different from each other, I think you probably know there is this test called NCE. Basically, what it does, it tracks two time series and sees whether those are two statistically different time series. So that's what the test that we do. That's for data reconciliation, data quality checks. After the data quality checks are done, then we construct a decision tree on the account level data. So there is a very fixed guideline for how the decision tree will be constructed. All the parameters are set. There are a bunch of tests that they use. That is also set there as well. Those are actually statistical tests. You probably know the Gini coefficient that they used. So, and then there is something called weight of weight of evidence that we calculate. That is also a statistical test, following which after the credit probabilities are built out, we do what is called the post-effect analysis. So basically, we stress test the credit risk model under different economic scenarios. For example, the economic guidance team gives us a bunch of numbers from, let's say, this scenario will happen, that scenario will happen. So based on the scenarios, we test our models, how our models will give a churn on outputs. So once we have the outputs from the stress testing results, we weigh them probabilistically and then create a distribution around it. So that gives a model, gives an idea that this is the mean value of defaults, and this is the distribution look like. So accordingly, we use a certain percentile of the distribution. Let's say we want to cover for 60% of the distribution as our provision, so that if the bank if the defaults become too high, we can set against those losses. So yes, you do have to know a lot of risk management, a lot of statistics to be able to work in risk management. And even if you go higher up the level, you would not have to know that much of statistics, but then you won't have to be hands-on that much statistics, but you have to be very careful with the statistical analysis. For example, when I first joined the firm, there was this Oman portfolio that they were analyzing. Review also Oman portfolio was going on. So what I observed there, so what was being talked about there was during the COVID period, there was this called payment free. So what happened is the government imposed a moratorium on the loan. So for example, if you are paying back some installments of loan, so government said you don't have to pay back the loan for a certain period. That would not affect your credit score. That would not affect your any delinquent status. Delinquent status means how likely you are to go to default. So those would all be frozen. So basically, it's a clean history for say 9 months. So, but it wasn't it was more of a, you can choose to take a delinquency freeze or you might not choose to take a delinquency freeze. So because the customers are given an option, so you would assume that those who have taken delinquency freeze, who have chosen to go on a delinquency freeze, who are those people who are likely to default, those who cannot pay back the loan, right? But what turned out to be the case is the people who did not opt for delinquency freeze, the people who were thought to be riskier than others, went default at a much higher rate than those who opted for the delinquency freeze. So that was a very counterintuitive result, and then it had to be, and then it was first analyzed when the result that the difference was first picked up by the review team, and for that a bunch of tests were carried out. So there are a bunch of guideline tests. For example, there is one KPSS test that they do to figure out that how the loan flow rate occurred for this particular account that went into default. So they analyze this kind of data. So even if you are not hands-on in statistics, as you go higher up the ladder, you have to do the interpretations about what went wrong there. So that's the kind of thing that you have to do. I'd say I wish I knew this before. Risk management isn't totally about statistics. I'd say it's not about what you do with the data. It's about how to figure out what data is off. Like more specifically, you are not paid to make these models. You are not paid to make the churn out these numbers from the model. You are paid to figure out why this model is behaving like the way it is. If some number is off by some amount, you have to be able to understand why that number is off. So, as in the case of Oman, they trace the accounts down. They do the root cost analysis of the particular accounts that went default while not opting for the delinquency fees. They understood that what they figured out is that the customers that went default had one unique characteristics, that they were all catering to a uh, they all had a medium net worth. That means compared to the overall portfolio, they did not have a very high net worth or very low net worth. Also, their income source was stable in the sense that they had very I'd say durational cash flow, but their cash flow did show some significant variation during the COVID period. So that's what that happened. So the next set of measures would be to take us to use these particular kinds of accounts as a separate segment and treat them separately. Their risk profile will be separate because although they have a very stable cash flow in normal times and they have a medium net worth, but in the COVID period they had a very high fluctuation in their cash flow. So this would be, so if some other I'd say not pandemic or any kind of economic crisis hits, so we should be segmenting these customers as a different segment and then developing their risk profile differently from the rest of the portfolio. That was the idea. And the second, for the second question, on will it be needed for any role in investment banking? Yes, very much so. Because some of my friends are in JPMC and Morgan Stanley. What I hear from them is they are mostly placed in model monitoring. So I should say in the JPM, in any risk management teams, there if you're entering as a analyst, you will have a bunch of roles. You have implementation roles. Implementation roles are those who take the model to territories. Sorry, any kind of risk model to production. You have controls roles, as I said before, they basically check against the parameters. So whether they see the parameters are correct or not, this is the controls team. You have the model monitoring team. They basically, when a model goes to production, they basically check whether the model is turning out results as it is expected, or if the data that is being fed in the model is as expected. So this is the model monitoring team. There are model validation team. The model monitoring and validation does the kind of the same thing, and you have the model development team. So this is the kind of teams that we have. So for the implementation roles, for the controls role, you don't need to know the statistics much. But yeah, but for the any kind of model related to model validation, model development, model monitoring, all these kinds of roles require you to know the statistics. And in JPMC, I know for a fact that in JPMC, most of the roles are in model monitoring and model validation because the model development team is not in India. The model development team is based out of US. I presume the same for Goldman Sachs. For Morgan Stanley, you have some teams for model development in counterparty risk. You have some model development for retail risk, auto loss forecasting. But they don't have any team. But they don't have as such a very dedicated team for model development. So most of the roles that we find in Morgan Stanley is model monitoring and model validation. Also the controls and implementation that you find there. Also, you will find the model development team in UBS. You will find the model development team in Amex. There is also a team in Nomura, a Japanese investment bank. You have a model development team, I think, in Standard Chartered as well. So, in most of the major retail banks, that will find the model development roles. But as you go higher up the ladder in the tier one investment banks, you probably won't find any model development roles. And even if there is one or two, those will be very reserved for the IITs because they are very selective about IITs. That's what it is. Kind of the same. Basically, it's risk. Kind of the same, but there is a difference. Risk managers are basically have to have a holistic idea of what is going on with the bank's portfolio. So quant analysts is a very a very restricted role. For example, I can be a quant on a say I can be quant on a retail portfolio. I can be a fixed income quant. I could be a derivatives quant. I could be a market risk quant. So when you say quant, you have a very specific goal in mind. So you have a very specific area of what in your mind. But when you go to a risk manager, when you are the risk manager, you have to have a holistic idea. So for example, credit risk interacts with market risk. How does that do it? So for example, if you manage your credit risk well, that means you have much more capital in your much more cash reserve in your bank with you, accounting for all the losses. So you cannot take more risk for the market. So for example, you can deploy the additional cash reserve to buy up stocks, you can buy up bonds. So you can if you have better war chest, you can go over to the market risk. So on the other side, if your credit risk isn't well and you are gone using your stocks and bonds and if market fluctuations goes down, you're going to go bankrupt. So credit risk operates with market risk, and as I told you, operational risk is also there, transaction risk these are also there. So these obviously operate with your credit risk and market risk as well. So all these kind of risk interact with each other. As a risk manager, you should have to have a holistic understanding of these three areas of risk and how they interact and what do they mean for the bank's balance sheet. So these are the kind of thing risk manager does. But a quantitative analyst, quant analyst or a quant is very much focused on a particular area. They have only one objective. Let's say they have the objective of figuring out a model that minimizes the provision loss, minimizes the provisions, basically the amount of bank that has to set up against the losses, minimize the provision while maximizing the capital available to the bank. So that is the kind of objective that a quant operates. So that is the difference. See, certification, I would say CFA FRM opens doors for you. More specifically, I would say CFA opens doors for you. If you have a CFA, it will open doors for you. CFA by CFA, I mean you have to go at least for CFA level 2. Because the problem in CFA level 1 is there are lots of people who have done the CFA level 1. So that won't that won't be a very much differentiator for you, especially if you don't come from tier 1 colleges. So at least you have to go for CFA level 2, and then if you want to take off an FRM or an econometrics course, that will be good. This is the basic certifications that you need. And for skills, I would say you have to be very good at statistics. And obviously, see, learning finance isn't that much difficult because finance is mostly about lots of definitions. You have in the first few months of the job, I had to learn, I think, close to 1,000 or more definitions. There's hundreds of thousands of terminologies there, so you have to know that. But that is not the hard part. The hard part is able to interconnect between them. So, for example, I would just do this exercise. Take out any bank, go to their balance sheets, understand what their income statements, understand the income statement, understand from where they are taking on loans, how much they are taking on the loans, what are their provisions, what percentage of provision is respect to the capital, and compare with other banks. Let's say, for example, you're taking out the banks from HSBC, you compare against Standard Chartered, you compare against Barclays, you compare with UBS. So you take out an RBS. You take 4 British banks, so they compare against UBS is not a British bank, sorry. So you compare against these 4 banks and see how their capital allocation, how their cash flow are different from others, and try to figure out for what segment those are different. For example, I just said to you that HSBC differs in HSBC's most revenue sources from APAC region, and even if you look at the APAC region, specifically comes from mainland China and Hong Kong. So these are the major revenue drivers of HSBC. Now, if you can dig deeper into Hong Kong and the mainland China, you will see a huge portion of the revenue is coming out of their wholesale lending business. So now look into who they are lending to. So you figure out those lending out most of the business of Macau. They're lending to they're called Shenzhen province of China. They're lending to Shanghai province of China. These are the province of China that they're lending to, and that's how they're deriving their revenue sources. So automatically it brings to your mind. So what happens in those regions will affect the HSBC. So for example, if Shenzhen and Shanghai was shut down, obviously in this quarter, this quarter as a COVID grows in China, Shanghai and Shanghai and Shenzhen was shut down. So automatically by this quarter, we should expect the HSBC should be under stress from those areas. So if there is a risk, so you should have an understanding that if there is a risk to the HSBC that comes from those regions. So you have to, so for example, some geopolitical crisis is going out in those regions, you will know that HSBC's balance sheet will also be affected. So this is how you have an understanding of the banks. So this is the kind of knowledge that you have to work in a risk. So this is what you do. And as I was saying that why should you learn statistics? Because the statistics will help you to methodically analyze all these things. So for example, if you're comparing against these metrics for different banks, you put them in an Excel sheet and as I said, you dig down all those geopolitical factors into account or macroeconomic factors into account, and you trace the relationship between those macroeconomic and geopolitical factors and the metrics of those banks. So you find a relationship. So to extract that relationship, you will have to have some statistical knowledge. So for example, in this case, you will have to probably use co-integrations. You have to use you can use generalized normal linear regression models, but it's recommended that you use the integration because that is most statistically sound. So those are the kind of things that you have to. And what should the red mark for undergrad students should follow to prepare themselves to be future risk analysts? I also first study the balance sheets first. Sorry, the financial statements of the banks first. Figure out what those statements, what those terms are, what do those terms mean, and how do those actually impact the bank's risks. So first do that. Once you have done that, you try to figure out what sort of statistical skills that are needed. For example, uh, if you're going to credit risk, you would mostly be needed a much more knowledge on logistic regression models, survivor analysis models, all these models that all you have to know. If you're going to market risk, you have to know a bunch of models. For example, Black-Scholes model that you know that is for that predicts a prediction market. So that you have to know. You have to understand how the volatility takes place. What is VAR, value at risk? Value at risk is basically standard deviation of a stock's value. So you have to know what is VAR and what are the most importantly also we have to know what are the limitations of a particular metric. So VAR has a metric, VAR has a limitation that it is not good as marking out outliers. So if there is an outlier event, VAR doesn't capture that. So you have to know what the limitations are. Um, you will also have to understand, uh, you know, so you also have to understand that how much. Um, so basically, there is this called sensitivity analysis. So as you go on taking on much more load, you also have much less protection against the market uncertainties. So you will have to figure out for every individual bank, it will have a criteria by which it determines. So you will have to understand how those things are done. Like these are called bank ratings, these are called AA, AAA ratings. They are called. So you have to understand how those ratings are calculated. So if I was starting back, I would first want to learn a bank's balance sheet, understand what all are terms are there, what do those mean, and how do they relate to the bank's balance sheet and other financial statements. That's the first thing that I would do. And then next I would develop a deep understanding of the econometrics. So take up any econometrics books. There are large number of econometrics books there in the markets. Take out any of those and read those up, and then um, I'd suggest go on to read some papers. For example, there is this paper, open source paper from Moody. So it's called Credit Metrics, the credit risk model. Just learn how this model has been built and what are the limitations there are, and then you study. What are the key models used in the market risk. For example, you use the CAPM model, capital asset proxy model, and you have the Black-Scholes model. You read those up as well. And once you have read all those up, then you talk to some people who are in the industry to see what kind of work do they do and try to replicate those. For example, I tell you, say we have, I can give you a certain kind of data structure. So they have the accountable information. With that accountable information, they predict what if some account is going to go default or not. So replicate those kinds of things. Have a knowledge of regulations because everything that is done at bank are done at the behest of some regulation. For example, you have IFRS 9, you have Basel, you have CEC in the US. So learn about all these regulations. So and I think that should be enough for you to get a job in bank. And do you have any more questions on this? Oh, by the way, there is one more area of risk that is coming up that is called climate risk. What they're doing is as you can understand. So if I have a housing, say let's say some around sea beach, so the rising sea level will affect the price of my house, right? So if I've taken a mortgage against that particular house, so as the weather events deteriorate, the house price will fall, and hence the mortgage collateral value will fall, and the portfolio that has my house will be at risk. So to analyze that kind of things, banks are coming out with this area called climate risk. They're using some sophisticated climate models to predict at what areas they're most exposed to risk, and thus they're adjusting the collateral values accordingly. And that is one interesting area of risk that people are now working in. It is very interesting. I'd like to move into that after some time. So that is there, and yeah, that's what I wanted to tell you. might want to explore the what climate risk is, because that is getting very much in steam, and I predict that it will become mainstream in a couple of years. So, like we have this market risk and credit risk, the climate risk will be of a separate domain of itself.
Yes, I think the session was quite insightful for everyone who joined today. Will it be possible to recommend a few beginner-friendly courses on statistics or econometrics might be
Uh,
needed?
Let me just. I think there was one very popular econometrics course. Let me just search over it. Jeffrey Woolridge. Yes, I forgot this book's name. The book's name is Jeffrey. The author of the book is Jeffrey Woolridge. He has a very good book on introductory econometrics that will be good. And for risk, for risk, you can follow one more book that is just just hold on a second. I shared one unit series. This unit series contains, the credit risk and market risk. So this is a very good primer. This book is a very good primer for that. Of course, a very good primer for that. Other than that, I will suggest two more things that you should study. One is paper. There are two famous papers on that. One is credit metrics. Yeah, this paper is very very seminal. It's like a foundational work on credit risk management. So it's one of the handful of credit risk model, production ready credit risk model that are actually open source. That is one you should study. The other is, hold on a second. Last one is basically a course on quantitative finance. It's from MIT. It's a pretty involved course. It's a bit difficult. So before you go on to this taking up this course, make sure your basic statistics background is all right. Then only you can delve into it. And also, I suggest following this guy called Paul Wilmot. Paul, I'll just write the name out here. Paul Wilmot. So this guy is basically working for a Confit. So he has a bunch of courses and a website, which is very good for understanding Confit and other risk management practices. So you can follow that. But the most important thing that you have to understand is everything that happens in a bank gets reflected balance sheet and income statement. So unless you're good with those things, you won't have an understanding of what's actually going on. Because I had studied all these courses, so I could understand only I could understand what bank actually does when I started doing the job. Because then I could understand how this particular metric relates to the financial statement at the end. So unless I'd say the first thing that you should go on to study is a bank's financial statements. After that, you go study anything else. That's what it is.
Anything you would recommend for basic statistics?
What basic statistics generally which book is enough, econometrics is enough. You guys are well versed with linear regression and basic statistical tests, right? You guys have to study in second year, I think. And even if you are not, take up some introductory statistics book for anywhere. It just works anywhere. I don't know. Yeah, I was from West Bengal, so there was this book called this book written by two non mission teachers on statistics. You can just take up those for 11 and plus 11 and 12. So just read up those. Or take up any introductory statistics. Do you have any more questions on this? Oh, by the way, I have forgot mentioning two important regulations over in this place. IFRS 9. Massive. So these are the two regulations. IFRS 9 is basically IFRS 9 is basically used for the credit risk model and basically is for capital provisioning. So these are the two regulations that are the mainstay in the world market. And for US basically a CSL which is similar to IFRS 9. So you have to have an understanding of what this IFRS 9 model asks you to do and Basel modeling wants you to do. So these are basically the guidelines that is set out that you have to have this sort of model. The model should satisfy these parameters and these conditions at the bare minimum. And they provide the guidelines within which you develop your risk model. So if you have an understanding of IFRS 9 and Basel, you will be good to go. And I would say if you know about IFRS 9 and Basel, that gives a very competitive advantage in the job market because most people these days I see they are all like they have all have done some competitions on different useless. So if you know about IFRS 9 and Basel, that automatically makes you a favorable candidate because you know what actually needs to be done, not those very complicated XG boost and other statistical models that we use in Kaggle. And forget about Kaggle. Don't do all those defaulted predictions from Kaggle or the stock market stuff. All the stock price predictions from the Kaggle. Those are basically virtually useless. There's no need for it. If you actually want to do stock market prediction, what you can read up on is fundamental analysis. So basically, take out some balance sheets, calculate some metrics on them. So, for example, I don't think you know, but still I'll tell you. So there are a bunch of ratios there, like cash flow ratio. There are return on equities, and there's a turnover ratio. There's a bunch of ratios are there. Use those ratios as variables against stock prices. So try to figure out what metrics is helping explaining in what by which variable is explaining by how much of the output variable that is the stock price. So you do those kind of exercises; those are much suitable. And then you use those methods that are called this model is called CAP, capital asset pricing model. You use the Black-Scholes method. You use I forgot what it's called. That there is another model. Let me just look up in the internet. Discounted cash flow model discounted cash flow models, these DCF models, these are good. And then you will have an understanding of what's going on there. That is the kind of thing. Also, try to find out some use cases. For example, um, try to understand where a certain model is being used. For example, when you're using BARD model, value at risk model, so it's a kind of model that you use in in market risks. So try to understand what its limitations are and how it can be how you can go around the limitation. For example, bar is the limitation of bar is mitigated with the help of another model called the Sortino ratio. Sortino ratio helps you go around that. Sometimes you will have sometimes you have to use the Bayesian methods. So there is a class of statistical methods or Bayesian method that is used to bypass all these limitations. So try to figure those out and kind of read the academic papers. Sometimes the academic papers are good. I suggest one Girl paper that is very good. Just let me look that up.
Sure.
No, I cannot find it now. I'll share that later with you. I cannot find it now, but that's a very important paper to read out. So I'd say do all these things. Also. Yeah. Do you have any more questions, or we should close the session?
I think we can close it for today.
Yeah. So, by the way, okay, if you wish to contact me, you can contact me over WhatsApp. Don't email me because most of the time I don't check my personal email inbox, so probably your email will go unanswered. So it's rather just text me and I'll be answering that there.
Okay, sure. Thank you, sir.
I think it's shared with Shomadip, I believe.
Yes.
You can share the contact number with me. Bye.
Bye, sir. We will end the session here.